Joining me right now for our conversation is Ademidun Shogo, who is an economist at Proshare. Hello, Ademidun, and welcome to the program.
Good morning. Thank you for having me.
Good morning. We're going to be talking about banks today, and it's really interesting that it also coincides with when the organization released a Tier 1 banking report, which is the second in the series. In the last few weeks, I've really been thinking about Nigerian banks and the kind of profits they've been making. So for me, it's really been where are these monies that these banks are making in an economy that is struggling. But Ademidun, let me come to you first with what I saw in your executive summary, which is a bit interesting for me. At the beginning of your summary, you did mention that banks are dead, but banking is alive and well. And it got me thinking, indeed, I think banks are dead because banks are just a tangible object, but banking is a service, which is banking is also a subset of the financial services. So just please explain that, what you mean by banking is alive and well, despite the revolution that we've seen, even since consolidation.
Okay, thank you very much for the question. So for that particular phrase that banking is alive and banks are dead, we wanted the reason behind it is that we are trying to look at how banks has evolved recently. So we've seen that we don't have the usual bricks and mortar anymore, where every other transactions or whatever you have to do in banks has to be in the four walls of bank. So now we have various product services that can be carried out outside the bank. So that means that the banking is going to become relevant, yes, as long as technology evolves the world. That means that banks have to be very intentional to adopt the style of banking. So as people evolve and demand, and their lifestyle demands a new type of banking structure, they have to adopt that, and that will make them stay relevant. So banking is the main thing now, and it has to do with evolving with technology, moving in line with trends so that you can meet the needs of all your customers.
You just captured it there because even for me as a person, I don't like going to the banks. I really don't. I detest it. If you see me in the bank, that means I have no choice. Especially now that you can just do everything with a click, on your phone or on your mobile device. So speak to me about this Tier 1 bank report, which you and your colleagues released. This is the second edition. I also know because I saw the first edition when you released it. What is the difference? Is it just methodology? Speak to me about the differences there.
Okay, so for the second edition, we decided to look at it at a more holistic way. So after doing the first edition, we noticed some underrepresentation of some of our variables. We actually got feedbacks from some of the key industry players too, and we decided to expand it, incorporating key metrics for the banks. So some of the metrics we added to it is the efficiency ratio. That's the cost to income ratio we had. It wasn't there before, and we needed to look at how banks are efficient in containing their costs. We had a cost of risk, yes, under the risk side. Banks are now riskier than before, especially with the new structure that we have. We have the financial old school structure, which is not what we used to have before. It used to be universal banking structure before. So that expanded, has complexified their risk, also in terms of regulation. So we had to look for a broader way of actually checking for their risk. That's why we included the cost of risk to the capital adequacy ratio that was initially stated in the first edition. Then we wanted to look at a very important part of banking, that is the digital banking. So like you've earlier discussed, we said that banking, digital space is very important for banks now. So we want to look at their earnings, the earnings they are making from digital services that they provide. So we looked at the digital earnings to income and to the gross earnings. Then the final one that we included was the governance. It was stated in the first one, but we expanded it by looking at the independent non-executive directors ratio to the total board of directors. So we looked at all that just to see how banks are faring. So this particular report shows us the total assessment of banks and their rank. It's an all-round assessment of banks to see that they are really Tier 1 or really Tier 2. So it's not based on the extant methodology, which actually prioritizes only the assets size. So for banks that have higher asset, definitely they're in Tier 1. But now we are looking at it holistically. So all across the major metrics, we are looking at how banks can really be Tier 1 and how they are also, and some also fall under the Tier 2.
This is quite interesting because from your report, you also noted, and from what you said, that in categorizing tiers for bank, tier one does not really just deal with asset size, but also asset quality. You know, because you can have, I always say, being big does not mean you are better, as it were. In the case of Nigeria, for example, we're the biggest economy on the African continent. But it's not that we are better. South Africa would be categorized as a more advanced economy, more than us. So being big does not mean you're better. So I would really like you to explain that, because a lot of people might just be within that space of saying, okay, asset size. You see that a lot of banks, of course, are bigger than the smaller ones, but the asset quality. So you're talking about the importance of efficiency. I would really like you to expatiate on that, because that can actually also mean for people or even bank customers to look at banks in a different way, and not to say, okay, I need to bank with this bank because it's big, but because it's giving me efficiency and because I know that I can get they listen to me, you know, some other qualities. So speak to me about that.
Okay, thank you. So in terms of the asset quality, we use the non-performing loan ratio to capture that. So we look at the percentage of bank loans, yeah, exactly, percentage of bank loans that are truly not performing well. So if for a bank that has higher one, yes, definitely suggests that in terms of your assessment, this will affect your assessment. So it's a very important part of assessment. Also, we looked at the efficiency ratio, that is the cost to income ratio. So that means that we have how are you being able to contain your cost. So we know that we are in an inflationary environment. We have inflation has increased to around 26%. Yes, as at the last one that was released at 26.72%. So definitely we have costs are a lot for banks. And also looking at the regulatory cost, which we've written a report about, that we have the regulatory cost is actually a larger percentage of their operating cost. So we want to look at how banks can cover their costs efficiently, reduce their costs during this period, so that it speaks to investors. So an investor can actually look at all these metrics and say, yes, for me, I expect this bank to do well. What is their history? What is their performance in terms of reducing some of the risk they are exposed to? So the non-performing loans, like I said, is still bringing us back to the risk, to the asset quality. It shows us the overall performance of the bank.
Ademidun, let's take a look at some of your infographics, and I would want my team to put it back on. Of course, because of this program, we have to call names. This is a financial program. So let's take a look at some of the rankings. You're seeing Access Bank, UBA, Stanbic, Zenith as, okay, 2021 Tier 1 ranking, 2022. Just speak to me about the graphics we're seeing right now. Stanbic is out. Fidelity Bank is also out there. So how can our viewers understand what is there?
Okay, thank you. So the first one has to do with the full year, our 2021 methodology. That was the initial one we did in 2021. Yeah. So we had the people that fell under the Tier 1 classification is Access. We had Access Bank. We had GTCO. That is we had GTCO. We had the UBA. We had the UBA. Zenith. We also had Zenith was part of it.
That's
we had
5.
Stanbic and Fidelity were the 5 Tier 1 banks then. Yeah. But coming into full year, after we added new weights and also added new methodologies, we have new metrics rather to the methodology. We saw a fallout of Fidelity Bank. And that's not because they didn't do well, it was because of the adjustment of the weight and the methodology. So because looking at their financial statement from 2021, 2022, they did exceptionally well. We see some significant growth in terms of their profitability and also some of the metrics I've discussed earlier, but we saw them drop. Then we wanted, during the period of our computation of all this analysis, we noticed that most of the banks has released their H1 results. So we wanted to preempt and give a suggestion to how the market is going to perform, in terms of your performance for full year 2023. So that is why we did an analysis for the one of H1 2023. So we saw another bank fall out again. That is the Stanbic. So we had ETI enter in H1 2021 and in H1 2023. For the full year 2023, we saw Fidelity come out of the Tier 1 rank, and also we had the FPNH enter into the rank. So for now, based on our H1 2023, we have 2 banks out of the rank. That is the Stanbic and Fidelity, while we had a re-entry we had the entry of FBNH and also ETI, that is the Echo Transactional Corporation.
Now, Ademidun, speak to me about what we're also seeing in recent times. I can't remember which governor now abolished it, stopped it, where we saw that banks were going into the holdco structure. But I think the former central bank governor, Godwin Emefiele, encouraged that. And the banks are coming back to the holdco structure where they also have other financial services being within the holdco structure. So you see the banking, they have insurance, they now have pension. Who abolished it? Is this Soludo? Oh, no, Sanusi. Yes, I remember. Sanusi was the one that said, banks concentrate on your banking business. And in fact, give them 10 years at that time, which has also been revised. But we're seeing that adjustment again, the holdco structure. Speak to me about your analysis concerning the structure of banks that we're seeing right now.
Okay, so the new structure of banks, that's the financial holdco structure, it's slightly similar to the universal, but what the difference between it is that we have the bank is also a subsidiary. So under the universal, we have the bank on top and we have other subsidiaries. But this time around, the banking and all the subsidiaries are standing alone while the holdco is the umbrella. So this was discussed in one of our reports. We talked about it under this report, saying that it actually complexifies regulations and risk. That means that we have regulations for each of the subsidiaries can be very complex because they all have different regulators for that. There's an infographic that we did showing all the regulators that would fall under the holdco itself, so which is more complex, and also the risk. We have most of the banks. The banking sector is like 80% of the total financial holdco structure, of the structure. So that actually exposes them to a sort of risk. That means that if anything happens to the banking sector, it's going to spread to other sectors. So it's good, yes. We have some of the positive part of it because it allows them to just outsource some of their services to all the subsidiaries and they can make more profit and also reduce their costs. But there are some of the loopholes that needs to be adjusted, and I'm so sure that CBN is going to do something about that, including some of the gaps.
You know, and that was why I asked that question, because I can imagine what Emir Sanusi, at that time, SLS was the governor of the central bank, and he really kicked against it. From what you said now, the different structures under the holdco structure, you see the banking, you see the insurance, you see pension, all those structures, of course, they have their regulators, the CBN there, NICOM there for insurance, PENCOM for pensions and all of that. But even the holdco structure, the organ of them all, who regulates them? You understand what I mean? I think in the UK, I think they have the Financial Services Authority, if I'm not mistaken. Is it in the UK? Yes, I think so. FSA, you know. So who regulates the baba of them all? Which is, and we're seeing that majority of even the income that will service or that will create those strata is actually coming from the bank. So if there's any risk to the bank, there's going to be a contagion effect, you know, across all sectors. So I just hope that the regulators are watching this. There's a new management at the Central Bank of Nigeria now. I don't really know what their thinking is around that. And a lot of resources have also been used by the banks to get up this holdco structure. So I wonder what would happen with them. Now, let's talk about some of the things that were included in this report, which is also digital income. We're seeing that many bank customers right now are really about service, you know, are more service oriented and even more speed oriented. I want to do banking transactions on my mobile device, and I want it to be fast. And I want it also to get to the person that I want it to get to as soon as possible. What would you have to say about that, especially with the advent of fintech? That, in fact, the fintech guys really gave the banks a run. They were there before even the banks entered. So it's like before the banks got up from their slumber, the fintechs have taken over. And of course, they have the financial heavyweights, so they are going into all of that. So speak to me about that revolution that we're seeing on a fast lane for the banks.
Okay, thank you. Let me start from the last part that you said. That is the fintechs. So like you said, we have the fintechs are stealing the shine when it comes to technology and adoption of financial technology. So let us give a practical example. During the cash crunch period, we saw that it was the fintechs that actually came to our rescue. We have most of the Nigerian banks have had lags. they had issues, they had breakdown during that period. But the fintechs were the major source of transferring money. So that shows that we have banks are doing well currently. We have in terms of integrating technology, but they still have they have a lot to learn to integrate. We've seen that their digital incomes are actually increasing. I think I was doing analysis on one of the banks recently, and I saw that it was around 50% increment from 2019 to 2023, which is quite commendable. But they still need to do so much in terms of deploying services-based products. We have products that will align with customers' lifestyle. So we have to be more customer-centric. We have patterned their products to be in line with what customers need. And that will help them so much. And it also help them, the integration of more technology will help them to reduce costs. So fintechs, they don't have the regular buildings. Their cost is small, but they're making although most of them are not listed, they tend to be making a lot of profit. And also they've helped in terms of financial inclusion. So because of some of the product they use, you just have to possibly just have your phone and you can do most of them. Even the people, because Nigeria has a very large unbanked population. I think as at the last time was calculated, we have 47% are banked, adults are banked. So if we still have that large base, that means that we need products and services that are very accessible for individuals, for the population, considering that poverty is very high in the country. So people that might not have access to big phones, they need products that can also meet their needs. We have services that can make them come into the banking system. So it is quite important for them to prioritize integration of technology currently.
Ademidun, let's take a look at the earnings of banks. Like I mentioned at the beginning, in the past few years, in fact, even from COVID, we've seen that banks are making more money. During COVID, I think they made so much money, of course, because of digital income, like you mentioned earlier. All of us were locked down in our houses, but we were doing banking transactions and even financial transactions. So speak to me about earnings versus the profitability of banks as against CBN's macro-prudential guidelines. As well as what the central bank, for example, the CAR, capital adequacy ratio, as well as even the non-performing loans. Of course, during MPCs, we get to hear the CBN speak about these ratios and how the banks are doing. So speak to me about that even in a depressed economy, banks are making money. And how does even this foreign exchange crisis really impact? Because the banks have also been challenged. The banks are also being looked at. That part of the problem we're having in our FX market is also perpetrated by banks, as it were. So much arbitrage coming in from the banks. Look, take your mind back during the Naira redesign. For example, that was last year where CBN was going to the banks and the banks were hoarding new cash to give to their customers. And they were saying, these are our Nigerian banks, Sha. These are Nigerian banks. They were hoarding cash to give to the elite while customers were, at their gates and they were not giving. I don't know. Speak to me about that. So much to talk about the banks. Are they also being adequately regulated? I don't know if your report covered that. I know you understand what I'm saying, Ademidun. I hope my questions are not too much, but you understand what I'm talking about. And I know that you and your colleagues, when you were taking a look at this report, some of those things that I'm saying may have come up.
Okay, thank you very much. So let me start from the first one. That has to do with their earnings. We have in the current economy where we have inflation is very high, we have so many issues, growth is slightly slowing down. We have the banks are doing well. And we can trace two things to it. We have the first one has to be with the devaluation of the Naira. So most of these banks, we have, I think 60% of Nigerian banks actually hold foreign assets. So the devaluation of the Naira is actually positive for them. That means that they have to just revalue these assets at the prevailing exchange rate. So it's a profit. So they made a lot of revaluation gains during this period. So we saw that in their H1 and H1 2023 financial statements where they had gains. And also another thing is that we've seen monetary policy. We've raised rates so much, starting from 2022, started from when we had the Russian-Ukraine war, and now there's been several rate hikes just to contain inflation. And as the rate hikes persist, we have Lending rate for banks has also gone up. I think for the month of September, the prime lending rate was around 13.99%, and we have the maximum lending rate was at around 27%. That's extremely high from the historical levels that we used to have before. So definitely, banks are making money from that. So charging, we have the high lending rates, the revaluation gains, summation of everything actually made them make significant gains during this period. Then, and a further deep dive into some of your financials, we noticed that under their interest income, yes, aside from the non-interest income, that has to do with the revaluation gains. For the interest income, their investment security gave them a lot of gains too. So I guess most of them actually invested in the equities market. Now the equities market is doing well this year. We have a year-to-date return of 37%. We have across, looking at it based on sectors, we've seen around 80% year-to-date. We have 67% year-to-date for banking sector. So those are gains, and it gave them a lot of income during this period. So necessarily, banks are making money during this period, but we see them as windfall. We have especially the revaluation gain, because it is the revaluation gain is seen as a windfall because it is just a revaluation of their assets. If we see a reversal of the situation when Naira begins to appreciate, that means that we might not see something like that before. It's just a one-off situation, and we have the banks. CBN actually gave them an instruction that they should be very prudent in terms of spending the revaluation gains, that the gains should be set aside for a period when we'll have more adverse situation. That's if Naira appreciates, when we see Naira appreciate, and they need buffers during this period. So it shows that it's a windfall, and it's quite positive for them, and very positive for investors too. So as regards the question about regulations, we have banks are regulated currently, although there's still some loopholes. We've talked about the fact of this cash to reserve ratio. That's the CRR. The CRR is at 32.5%, very high compared to what we have in other countries. And that has affected banks' ability to give out loans to sectors, the sectors that can drive the economy. That's the real sectors. And we've seen them, compared to before, we've seen that the pace of loan disbursement has actually reduced. And we've seen banks complain so much. The statutory one, the discretionary CRR, is actually hurting banks' ability to give funds. So some of the regulations need to be toned down. Yes, we have, and the report, we actually said that the CRR needs to be revised if we're being growth conscious for the country. And also we asked for a recapitalization for the banks. We have the banks currently, they are the one that was approved by SANO, that's in 2013, when it was 2007, sorry. So we had the minimum capital size was 25 billion, and most of the banks seem to still be struggling to have that. Most of the banks we checked, they still have below that. And looking at the exchange rate, the value has been eroded of 25 billion, and 25 billion to fund a capital project right now seems relatively small. Most of our Nigerian banks cannot fund a very large project. So we feel like banks need more capital so they can give out more loans to actually grow the economy. And also in terms of their non-performing loans, we have, amazingly, banks have been able to reduce their non-performing loans. We've seen them as at 2022 was around 5%. That's across the average calculated by CBN. So that shows that they've looked for a structure, a style in which they've been able to cut down the number of unperforming loans. They've diversified their portfolio. So unlike before, when we see loans going to a major sector, that is the oil and gas sector, we've seen loans go to other sectors like manufacturing and other various sectors. Most of the banks, they have it diversified. So they are not only exposed to just one risk.
Ademidun, don't you think that because they were really coerced to do that, especially during COVID, that we saw them diversifying into other sectors, of course, because of the various interventions at that time from the Apex Bank in terms of, okay, our economy was going to be depressed during COVID. We need you to, there was the real sector facility whereby, of course, from the cash reserve with the Apex Bank, they must lend by force, by fire, by force to all those sectors. So you saw them lending and diversifying. So perhaps that is also as a result of regulation. Okay, just before you go, you've talked, of course, the future of banking. You've also saliently given the recommendations from your report, recapitalization of banks, look at the CAR again, NPLs, of course, are low. What other recommendations is your report giving to the banks? That's one. Then number two, did you really engage with the banks in coming up with this? Then number three, are the regulators going to see this? Is there any engagement with the regulators as to seen this? I don't know if we have time again, because all this you should answer in 2 to 3 minutes. Then the classification of the banks, which banks are tier 1, which banks are tier 2. Is that a tier 3?
Yes, those are ones that have negative shareholders fund.
Okay, so go ahead.
So, okay, for the first question, that has to do with other recommendations. So we made recommendation as reserve the balance sheet of the banks. So we had early this year, we had the issue of the collapse of some of the banks, and that was a result of the mismatch of their asset to liabilities. So we said to, like, the recommendation we made for this report is that banks should be more dynamic in terms of their assets and liability management. So it should not be static. We have to evolve and be intentional in terms of matching their assets. Although there's a section of the report that we checked. We have the bank's exposure in terms of their liquidity. We have exposure to government securities, and how, if there's a default, like what we had in the case of Ghana, where Ghana defaulted, and we saw some of our banks actually incur a lot of losses during that period. Some of the profitability actually declined because they had to make provision for it. So we looked at their exposure, and that suggests that banks need to be very intentional when it comes to asset management. We also made recommendation as being intentional in terms of technology, like I've stated earlier. We have integrating technology is highly important for them right now so that they can catch up with the global economy. We have the asset side of most of Nigerian banks are still small compared to global, when we look at it globally. So in other countries, we've seen them have relatively large asset side, and that is the reason why we are calling for a recapitalization for some of these banks. So as regards the engagement with the regulators, yes, there was a report that we wrote in conjunction with BIDAN talking about the regulatory costs. We have the AMCON fee and also the NDIC premium, how it's a very large percentage of operating costs and is actually slowing down banks' profitability. So we've engaged with banks, we've sent out some of those policies, we've engaged with regulators, we've sent a copy of the report to CBN, and that is what we're still doing currently. Then I can't really remember the last question that you asked.
Engagement with the banks.
The engagement with the banks. Yes, during the launch, we actually did a launch where we had banks come around, where we had a discussion with the banks. And also when we did the first edition, that was done in 2021, we have on 2021 financial statement in 2022, we actually engaged and asked for views from CFOs, from banks, so that they can give us a view about the assessment of the banks. And we got feedback, and that is what we implemented in this second edition. And we widened the methodology so that it can give us an holistic view, a very more realistic view of how banks are faring.
Okay, thank you, Ademidun. I know we can still drill further into this your report, because I've not even talked about the issue of cybersecurity, the future of even AI as to banking. But we can talk about that some other time. So thank you very much for coming on the program.
Thank you.